Hi, I'm going to attempt this recording thing here and go over the midterm review. I already posted just the review itself without the answers, then a second link to the answers. So if you wanted to print it out and work on it yourself, you can, and then you can also have the answers to check yourself. And now I'm going to go through it and I'm going to explain and work out the problems for you. So bear with me. This is my first time doing this, so have some sympathy for me, please. Okay, so chapter 5, the first one here is a company had $500,000 in sales and they had gross profit of $332,000. What is their cost of goods sold? Well, if you remember correctly, to calculate the gross profit, you take your sales minus your cost of goods sold to get your gross profit. So we can work it backwards. We can take the sales of 500,000 and we can subtract the gross profit, and that will give us our cost of goods sold, which should be $168,000. Okay, for number 2, we need to calculate the current ratio and the acid test ratio. So what I want to do is I'm going to move this up a little bit. Okay. Whoops, that's a little bit too much. Okay, that's whoopsies. This is going to be fun. Okay, just a tiny bit. Whoops, no, I don't want that. Okay, come on. Okay, we're going to work out each of these. And so the first one we're going to do is I'm going to do the current ratio. Which is current assets over current liabilities. Current assets over current liabilities. Now in this problem, the current assets add up to $348,590 and the current liabilities add up to $136,700. Divide those two numbers and you get a current ratio of 2.55. Now what I want to do is show you where I got these numbers from. The current assets are from, cash to prepaid expenses, not accounts payable. Cash to prepaid expenses are your current assets. And then your current liabilities, which was the bottom number, 136,700. Those, these two numbers added together give you your current liabilities. Current liabilities. Okay, now let's look at the quick ratio. Your quick ratio is a little different. It is your quick assets over your current liabilities. And this is 118,930 all over 136,700. Do the division here and you get 0.87. Your quick ratio is always going to be smaller than your current ratio. And the numbers that are used to get your quick assets, that is cash, short-term investments, and accounts receivable. These are your quick assets. And what they mean by quick assets is that what can turn into cash the quickest. Okay, let's look at number 3. Customer purchases $2,900 on May 5th with terms 110 net 30. On May 7th, they returned $320 worth of merchandise. Then they paid on May 8th. We need to look at what the amount paid was and what the journal entry to record the payment is. So the first thing we're going to do is we're going to calculate the return because they paid after the return. Okay, so we're going to take the $2,900 and subtract the $320 that was returned. So we're only looking at an invoice for $2,580. Now on May 8th, that's within the 10 days, so we're going to take our discount for that. Okay, $2,580 times 0.01, which is 1%, $25.80. This is our discount. To find out the amount that we actually pay, take the amount of the invoice minus the return, and then subtract the amount of the discount we just calculated. They're going to write a check for $2,554.20. Now, here we have the journal entry part. For this, the company is going to debit their cash for the amount of cash that they get. They're going to get the $2,554.20. This is the amount that the customer is paying. Then they want to record the sales discounts that they gave them of $2,580. Now, sitting in accounts receivable is the full amount of the $2,900, so we need to take that out. Accounts receivable credit of $2,900. Oops, gosh darn it. Okay. There, okay. Number 4. A company purchased inventory. So the first problem that we just had was a customer was bought merchandise. Now the company is the one that's actually purchasing the merchandise to sell. So company purchases $3,500 of inventory, FOB 0.310. FOB shipping point means the company that is buying the inventory pays shipping because it changes ownership at the shipping point. Then the company also returned $240 worth of merchandise, and they paid within the discount period. We need to calculate a couple things. The first thing is what is the total cost of the merchandise, and then the journal entry to record the purchase and the return. Okay, so I'm going to calculate the net amount. Okay, we have the $3,500 that they purchased, and they returned $240. So this is going to work a lot like number 3. $3,260 is actually the amount that we're looking at. And then from there, we're going to take the $3,260 and we're going to take the 2% discount that they get, which gosh darn it isn't in the problem, but it's a 2% discount. So this is going to be 210 net 30. I'm so sorry. Okay. So multiply it by 0.02 and they get to take a discount of $65.20. Okay, we want to subtract that from the amount of the invoice, minus $65.20, and we get a net amount of $3,194.80. This is how much you're actually going to cut the check for. One thing you don't want to forget though is about the shipping. The shipping, you don't take any discount off of the shipping, because the shipping is how much you have to pay to ship it. So we're going to take the $31,094.80 and add the $310. They actually owe $3,504.80. Okay, the total cost of the merchandise is going to be this amount. This is the total cost of the merchandise. Remember that what they do is they update the inventory anytime that you get to take the discount. So we took the discount here, so we have to update inventory. Then shipping is also added onto the cost of the inventory. Now let's look at the journal entries. The original entry was to debit inventory, the $3,500, and credit accounts payable, the $3,500. Then the return was the other journal entry. For the return, we want to decrease what we owe. So we're going to debit accounts. Whoa, I have no idea what I did there. Debit accounts payable, 240. Oh, this is great. And credit inventory, 240. Okay, I'm not really sure what happened with that. Okay, now, number 5. A company had sales of $150,200, sales discounts of $2,250, and sales returns and allowances for $3,605. What is their net sales? Okay, you're going to take the sales of $150,200. You will subtract their sales discounts, and you're going to subtract the sales returns and allowances. And we will get net sales of $144,345. This will be our net sales. Okay. Okay, number 6. A company had net sales of $820,000, sales discounts of $12,300, sales returns and allowances of $18,450. Their cost of goods sold was $389,500, and their operating expenses was $282,80. What is their gross profit? Okay. To calculate the gross profit, take their sales, subtract their sales discounts, subtract their sales returns and allowances, and subtract cost of goods sold. This is their gross profit. You take the sales minus those discounts and allowances. That gets you, so if you take this part, is going to equal their net sales. Then you subtract cost of goods sold, will give you your gross profit. That was all for chapter 5. Now we're going to go on to chapter 6. On December 31st of the current year, France & Company reported an ending inventory balance of $211,500. And then we have this following information. We want to know what is the amount that we're going to report on ending inventory. Okay, so I'm going to underline some key information. First of all, on December 31st, the ending inventory is $211,000. With the beginning inventory. This should be beginning. Whoops. Franson sold and shipped goods costing $37,300, and they were FOB shipping point. So they were no longer in ending inventory, so we don't have to worry about that. The goods were not included in any inventory, okay. Franson purchased goods costing $43,300 on December 29th. Those are part of ending inventory. So let's start this calculation here. $211,500, and then we're going to subtract this shipment that they just got. And then Franson's ending inventory balance of $211,500 included $14,300 goods on consignment. When it's on consignment, the person that owns that property includes it as theirs, not the person selling it. So this company has these goods and they're selling it for another person. It is not part of their inventory. And because it was included, we need to back that out. And then that's where we get $153,900 is their actual ending inventory. Oops, a little bit more. I'm sorry. Still trying to get used to this. Okay. Calculate the inventory turnover ratio. The inventory turnover ratio is cost of goods sold over average inventory. Here it says the cost of goods sold is $9,661, and they tell you what your ending inventory is, and they tell you what your average inventory is. Make sure you use the number that is your average inventory, not your ending inventory. 4.38 times. Okay. Now we get to our inventory, our FIFO, LIFO, weighted average, and everyone's favorite, specific ID. Here we're going to start with this first one of specific ID. And here we actually get to work backwards here. It tells us all of our purchases that we had throughout the year, and we're assuming that we started with nothing. This is a new company. And then we know ending inventory consists of this. So we're going to work backwards. Ending inventory consists of 26 units. We have 2 from January. January's cost was $120. Okay, then that's $240. Then they have 4 from February. February we're at $130. They have 6 from May. And the ones from May they purchased for $140. 4 from September. September was at $150. And then 10 from November, which were at $160. Their ending inventory is $3,800. So you always have to go through the full steps to get to the ending inventory. With specific ID, with this one, you can calculate it backwards from the ending, and it's so much easier. And this is how the problem is going to work on the midterm next week. Okay, let's go to weighted average, which is also not the easiest. And this one, you're going to have to calculate everything all the way through. Okay, I'm going to separate it out into 3 sections. I'm going to have the purchases, and then cost of goods sold, and ending inventory. Okay. Again, we're starting out at 0. So let's look at we purchased 10 at 120, which means our ending inventory so far is just 10 at 120, which is 1,200. Okay, then we purchased 20 at 130. So now in ending inventory, we have 10 at 120, and we have the 20 we just purchased. Okay, we have 30 on hand at a total cost of $3,800. We have to calculate what the unit cost is and divide 3,800 by 30, and you will get $126.67. Take 3,800 divided by 30. Okay, then we sold some. We sold 15. And we don't have to worry about what we sold them for. We just need to worry about the cost of them. These 15 came out at that $126.67 that we just calculated. So the cost of this inventory that we just sold was $1,905. Okay, let's see what we have left. We had 30. We sold 15. So we still have 15 left at the cost of $126.67. It happens to be the same amount that we just sold. Next, in May, we purchased 14 at 140. So in ending inventory here, we have 15 at 126.67. And then we have the 14 we just purchased, and that is at 140. We have 29 in inventory at a cost of $38.60.05. Okay, we need to get a new weighted average. Take the $38.60.05 divided by 29. And you get 133.11. Okay, then we sold 20 at the 133.11. If we sold 20, we had 29. We only have 9 left. And that 9 that we have left is at the 133.11. Gives us a total of $1,197.99. Okay, we purchased some more. We purchased 12. Whoops. At 150. Okay, so in ending inventory we have 9 at 133.11, and then we have the 12 that we just purchased at 150. We have 21 in inventory, a total cost of $2,997.99. Take that number, divide it by 21, and you get 142.76. Okay, almost done with this first one. Okay, we sold 10 at 142.76, which is 142.760. Okay, we sold 10, we had 21, which means we have 11 left in inventory. And the 11 we have left is at the 142.76. You only calculate the new cost of inventory when you purchase more, not when you sold more. Okay, and then the last one. Okay, here we purchased 10 at 160. Okay, we have the original 11. And then the 10 at 160. That's 1,600, 3,170 and 36 cents, 21. So this is our ending inventory, cost of our ending inventory, and then cost of goods sold is going to be the 05, the 266,220, and then 11 and the 1427.60. So let me calculate that. 1900 62.2 7276. So cost of goods sold is going to equal 598985, which is those three numbers added together. Okay, now we have two more left to do for the inventory, and that is the LIFO and FIFO. And we will do FIFO first. Can't go too fast, otherwise it gets away from me, sorry. Okay. Same thing here. Purchases. Cost of goods sold. And ending inventory. Okay, we first purchased 10 at 120, so that's how much we have in inventory. 10 at 120 is 1,200. Then we purchased 20 at 130, so in inventory we have the 10 at 120, and then we also have the 20. Okay. Our first sale, we sold 15. Now, which 15 did we sell? We're using FIFO, which is first in, first out. The oldest ones leave the warehouse first. The oldest ones are the 10. So we're going to sell those first. And then we need 5 more. So we're going to have to dip into the ones at 130, 5 of them. We sold 15 at a cost of $18.50. Okay, let's see what we have left. All of these 10 are gone. 5 of the 20 are gone. So we have 15 left at 130. Okay, we're getting low on inventory, so we just purchased 14 more, and those are at $140. So in ending inventory, we have the 15, And we have the 14 we just purchased. Okay, now we sold. I'm sorry, my Alexa, stop. I had my timer on for dinner. Okay, we sold 20. Now what 20 did we sell? We have 15 at 130 and we have 14 at 140. Okay, the 20 that we sold. Okay, the oldest ones go first. So these 15 we purchased first, so they're going to go first. 15 at 130. And then we need 5 more. And those are going to be the ones we have to dip into these at 140. So 5 at 140. Here's the 20. Okay, what do we have left? We have 9, because we took 5 of the 14, so we have 9 left at 140. Okay, because we're running low, we're going to purchase some more. 12 at 150. Okay, in our warehouse, we have 9 at 140. And then we have the 12 at 150. Oh. 30, 60. Okay, we sold some more. We sold 10 this time. And the 9 are older than the 12. So we're going to sell, well, first of all, we sold 10. Okay, so out of the 10, we sold 9 of them at 140. Then we took 1 of the ones that we have in inventory at 150. Okay, let's see what we have in ending inventory. We have 11 at 150. Because all 9 of those are gone and 1 of these are gone, so we have 11 left. Okay, this is our last one. We purchased 10 at 160. So our ending inventory, we have the 11 at 150, and then we have the 10 at 160. $21 in ending inventory at a cost of $3,250. This is our ending inventory. And then our cost of goods sold are, again, these 3 numbers added up, which is 5,910. Okay, so we have 1 more left to go. Whoops. Okay, we're gonna hold on for, okay, can I stop this? Okay. Okay, now we have 1 more to go. We have LIFO to do. So let's get this one moved up. Okay, and it's going to be very similar to FIFO. Okay, so I want to see, I'm going to put up a little bit more because the more room I have, the better. Okay, because it's the same information. Just remember this is LIFO. Okay, we have our purchases. Our cost of goods sold. And then ending inventory. Okay, let's start for LIFO with our purchases. 10 at 120, so that's what we have in ending inventory. We have 10 units at $120 each, and that's going to give us $1,200. Okay, and then we purchased 20 more, and those were a little bit more. Oh wait, those were at 130, a little bit more expensive. So we have the original 10 at 120. Then we have the 20 that we just got in at 130. Okay, we sold 15. And which ones did we sell? LIFO is last in, first out. So we're going to take the newest ones first. All 15 are going to be at 130. What we have in ending inventory is the 10 at 120, which are our oldest ones. And then we have 5 left in inventory at 130. Okay, we went ahead and we purchased 14 more. Those cost us $140. In ending inventory, we have the 10 at 120, the 5 at 130, and then the 14 we just purchased at 140. Okay, we sold 20. Which ones did we sell? LIFO means you sell the newest ones first. So these 14 went, which were the newest. So all of these are gone. Now we're going to take from the 5 here. So 5, all 5 of those at 130 are gone. And then we have one more to fulfill this order, and that one is going to be at 120. Okay, ending inventory consists of the oldest units at 120, and we have 9 of those. Okay, we purchased 12, and the price rose again. Those are at 150. We have 9 at 120, and then these 12 that we just purchased at 150. Okay, this time we sold 10. What 10 did we sell? We're going to sell the newest ones first, so all of them are the ones that we just purchased at 150. So 10 at 150. In ending inventory, we will have the 9 at 120 and only 2 of the ones at 150 because 10 of them we sold. And the last we purchased 10, these are at 160. Ending inventory, we have 9 at 120, 2 at 150, and then these 10 at 160. and all of those added up is $29.80. That is our ending inventory. And then our cost of goods sold, take the $19.50, the $27.30, and the $1,500. Our cost of goods sold is $5,180. Okay, so that finishes our 4 different methods of inventory. So we go into chapter 8 next. And I don't think I, whoops. I don't think I didn't. Number 13 starts chapter 8. I'm sorry, I did not put that in there. Okay, chapter 8 is on cash. Whoops. Pay attention. Okay. So the cash register shows that we have $1,264. But the cash drawer shows only $1,252. So what is the correct journal entry to record the cash sales? First of all, let's see how much we are short. If we take what the cash register says we have, minus what we have, we get $12. So we're short $12. We're going to debit cash what we actually have. You will debit cash what you actually have, not what you should have. And then we're also going to debit our over and short account, the $12, and credit sales for the full amount of what the cash register shows we should have. Whoops. Oh gosh. Where is it? What? Oh my goodness. Okay, 14. Now we're gonna look at whoops, this is twice. Okay. Petty cash. Okay, so Children's Company has established a petty cash fund for $500. And the fund was last reimbursed on November 30th. So these are all the transactions for December. On the 4th, they had a freight charge. On the 7th, they had delivery charge. On the 12th, they purchased some office supplies. And on the 18th, they donated to a charitable organization. Okay, if in addition to these receipts, the petty cash fund contains $246 of cash, what is the journal entry to reimburse the fund? Okay, the first thing that we're going to do is we're going to go through these 4 and put them into the accounts that they need to go into. If you remember from dealing with our merchandise inventory, freight charge is part of the cost of inventory, so we won't take that to a freight expense account. That's going directly into merchandise inventory. Merchandise inventory debit of $56. The delivery charge, however, this is shipping to a customer, so this is not the cost of the inventory. This is cost of sales. So this will go to delivery expense. Delivery expense is $80. Purchase of office supplies, we will debit office supplies, $45. And then donating to charity can go in quite a few different counts. Let's just take it to a miscellaneous. We'll take it to miscellaneous expense for 64. Now, If you add these up, you will not get the amount that you should. We are going to be $9 short. So we will debit over and short the $9 that we're off and credit cash for $254. And then once we replenish with $254, we are back at the original $500. Whoops. Okay, number 15 is a bank reconciliation. You only have to do one part of it, and we're going to do the book side. And this is the information that we have. We know that the cash balance per the company books on April 30th is $6,255. So I'm going to start over here with the book balance at $6,255. And okay, so that's done. Deposit in transit, that goes on the bank side, so we don't worry about that. Outstanding checks at month end also go on the bank side, so we don't worry about that. In fact, I will put bank side here. Bank charge for printing new checks, we do need to know about. Okay, so this is check printing. They took this from our account, and we need to now subtract it from ours. So we're going to subtract $65. A note receivable and internet collected by bank on Donahue's, spelled it wrong, Donahue's account. Okay, that's $730. So they collected it on our behalf. So this is the note receivable. So we will increase our account by $730 because that account was paid and they paid it directly to our bank account and bypassed us. And then check paid to Donahue during the month by a customer is returned as NSF. So the NSF, we added the money to our account, but then their check bounced, so we need to take it back out of our account. $6,400 is our new adjusted book balance. Okay, that is it for chapter 8. So we're going to go on to chapter 9, which is on receivables. And the first one here, we need to calculate a couple things. The first thing, we need to calculate the interest that's due and then the amount that's going to be paid at maturity. So this note is for $7,500. It's a 90-day. It's 10%. So we're going to take the $7,500, multiply it by the 10% and the time. 90 over 360. The formula here is principal times rate times time is going to equal your interest. The time is in years. And I know we have 365 days in a year, but we're going to use a banker's year, which is 360. 90 over 360 is 0.25. Okay, so if you take 7,500 times 0.1 times 0.25, you get $187.50. This is the amount of interest that's going to accrue over the 90 days. That's the interest due. then what is the total paid at maturity? Now it happens 90 days after. The note is going to have to be paid back of the $7,500 plus the interest of $187.50. The amount at maturity that's going to be paid back is $7,687.50. This is the total paid at maturity. Now, maturity means when the note is due. If this is a 90-day note, 90 days from its inception is the maturity date. The maturity date is the day that it's due. Okay, let's calculate the asset turnover rate. The asset turnover rate formula is net sales over the average accounts receivable. Now, I'm going to go easy on you guys. I'm going to actually give you what the average is. You won't have to calculate it. If you did have to calculate, you would take last year's and this year's, add them up, and divide by 2. Okay, the net sales is $1,339,800. Average accounts receivables is $406,000. And we get 3.30. Okay. Using the aging, company uses the allowance method. On May 3rd, they wrote off an uncollectible account of $3,800 from one of their customers. It should be O-N-E, one of their customers. What is the journal entry to record the write-off? Okay, let's look at their allowance account. Here's their allowance for doubtful accounts. It already has a balance of $1,000 in it. That part isn't written in the problem, but will be on the test, I promise. And we need to figure out what it should be. Oh, I'm sorry. I'm looking at the wrong account. Never mind. Okay, that goes to this one. Okay. If you're going to write it off, allowance for doubtful accounts will be debited for $3,800, and then accounts receivable will be credited for $3,800. This is what you do when you use the allowance method. Just if you use the direct write-off method, I just want to show you that. The direct write-off method would be debit bad debt expense and credit accounts receivable, the $3,800. This is the difference. This first one is the allowance method, and then the second one is if it were the direct write-off method. Okay, now let's go to the one that I actually started. Okay, using the aging of receivables, the company estimated that $34,500 of accounts receivable balance would be uncollectible at the end of the year. The allowance for doubtful accounts had a debit balance of $1,000. And here we go. This is the allowance account. So we're saying that we want it to be $34,500. What do we need to credit to get the $34,000? Well, we need to credit the account $35,500 to get it to $34,500. We will debit, bad debt expense $35,500, and then we will credit allowance for doubtful accounts, a credit of $35,500. Okay, number 20. Whoops. Oh, gosh darn it. Okay, number 20. Try this one more time. Okay. This time we're going to practice the percent of sales method, and it works similar to the one that we just did, aging of receivables. Okay, so at the end of the year, the company reported the following. They had a debit of $358,000 in accounts receivable. They had allowance for uncollectible accounts was a credit of $530, and net sales was a credit of $830. All sales are credit. What should be debited to bad debt expense if they estimate that 3% will be uncollectible? Okay, let's figure out what that 3% is. We're going to take the net sales of $803,000 and multiply it by 3%. That's $24,090. That is the amount that they say is going to be uncollectible. Okay, now let's look at the allowance account like we did before. It currently has a credit balance of $530, and we want it to have a credit balance of $24,090. What do we need to credit to get it to that amount? Well, we need to credit the account $23,560 to get it to $24,090. We will debit bad debt expense $23,560 and credit the allowance for doubtful accounts for $23,560. Okay, company issued a 90-day 7% note for $8,900 as a cash loan to an employee. Record the initial transaction, period, not a question mark. Okay, what is the interest that will accumulate on the loan and how much is due at maturity? This is another one where it's principal times rate times time will give you your interest. Take the principal of $8,900, multiply it by 0.07, and times 90.360. Remember, is 0.25. You get $155.75. This is the interest that will accumulate. Okay, how much is due at maturity? Okay, the $8,900, which is what the loan was for, plus the interest will give you $9,055.75 at maturity. Okay, to record the initial transaction is to debit note receivable the $8,900 and credit cash $8,900 because you're giving the loan to someone.